Howdy, Team 42. It's your skipper here, Darius Dell, to present another fantastic episode of Pro to Pro Live. I'm joined with the great Jim Bianco. First time on the program. Jim, welcome.
Pleasure. Looking forward to the conversation.
It's a awesome to have you, brother, for a variety of reasons. I was actually having a conversation with Jim Carson earlier today in one of these programs, and I'll give you the same exact compliment that I'll give him, which is you are in the very short list of people that I make time to review on a consistent basis. It's not to be pejorative against anyone else, but obviously time is a factor. We have a lot of other things we got to do. I got a 6-month-old son that I like to play with after work. And so there are people out there who are so good at their dang jobs, and you're certainly one of them, that their signal to word spoken ratio or their signal per minute of content ratio is off the charts, man. You're a phenomenal educator. I'm so grateful to have you on the program. I'm sure our audience will very much appreciate this.
Thank you. I appreciate the kind compliment.
Yeah, of course, my friend. So for people who've been sleeping under the world's most comfortable rock, can you give us a little background about yourself before we hop in?
Yeah, so I am the founder and chief cook and head bottle washer at Bianco Research, L.L.C. Founded the firm in 1998. So it's their 28th year in existence. Before that, I was the director of research for a small firm called Arbor Research and Trading, which is a small institutional independent brokerage firm in Chicago, in the Chicago area, from 1990 to 1998. Jim Stevens was my partner at Arbor Research, and he was his idea that I spin myself off as Bianco Research. I get to call myself president of something. Nice. I'm the third largest shareholder of Arbor. Arbor is the second largest shareholder of Bianco Research. So it's been 34 years that I've been involved with them. My main thrust is macro, and it's kind of with a fixed income bent because I am still affiliated with a fixed income brokerage firm. So I talk mainly to, bond portfolio managers, bond traders, and bond salesmen. But I've tried to branch off in doing more than just, getting into the weeds in the bond market. But I kind of start there and kind of go more macro with a lot of what I do.
100%, man. And speaking of bonds, I noticed you have, I want to say a bond ETF. Is that correct?
That is correct. In 23, what I technically did was I started a bond index called the Bianco Research Total Return Index. It's BTRINDX if you have a Bloomberg, or it's BiancoAdvisors.com. And then Wisdom Tree, my partner, started a ETF that tracks my index. And that's been about 15 months now that it's been undergoing. I'll say this, pro to pro to you. I'll say to you, we are in the core bond category with our ETF, which means that we're total return. We're trying to beat the Bloomberg Aggregate Index. 470 funds in the index or in the universe, a core bond, and we were in the 19th percentile. So we outperformed 81% of the people in our group. I am under no illusion, as I like to say to my professional friends, there will be a year where we'll be in the fourth quartile, because there always is, and you're naive to think you will never be. But it wasn't the first year. So that really helped me quite a bit in getting this thing off the ground. So we've gotten off to a very good start with it. So thank you for bringing it up.
No, that's amazing, man. Really, really proud of you for that, man. So that is awesome. I love pulling on these sort of threads in terms of institutional asset management products. What would you say is sort of your core, I don't want to say secret sauce, but what's your core sort of selling product relative to the other, I want to say, would you say 400 something funds in the core bond index?
Yeah, so two things I think we do that's kind of unique. The first one is we buy other fixed income ETFs. Yep. And I've written a lot about this. The efficiency of the ETF is such that it almost is better off to do it that way. I've been in a bond market for 3 decades, almost 4 decades, and I was like, man, these ETFs are so easy. Yeah. They're so transparent and they're so cheap to do. Yeah. So we put all of our ETFs that we own into a portfolio management program, and it has a little look-through function. So we could say, instead of us owning 15 ETFs, fixed income ETFs, how many unique positions are there aggregated in the 15 ETFs? And we analyze it that way. There's 18,000 positions between those 15 ETFs. Wow. And then, the question is, the all-in cost for us to own those ETFs is 4 basis points. If I had to put together a facility to buy and track 18,000 securities, it cost me a lot more than 4 basis points to do that.
100%.
And so that is, and there's so many of these sliced and diced fixed income ETFs coming out, very narrowly based and stuff. There's hardly a strategy I have not encountered that I can't do with an ETF. And what's interesting is that is fairly common in the equity space, that there's ETFs that buy other ETFs. You use ETFs to implement strategies in equities. In the last 3 to 5 years, it's become much more prevalent in the fixed income space where we've seen it there. The other thing I do, which I'll be honest with you, pro to pro here. I thought this was going to be a problem, but it turned out to be a virtue. Good. I manage an index. So what we do when we manage the index is we look at the weightings within the fixed income universe. How many corporates do we want to have? How many mortgages do we want to have? Do we want to have bank loans? What is our duration, our exposure to interest rates, our yield curve structure? These are the kind of things that we look at, and we reset them once a month with all these ETFs. And we hold it for a month until the next monthly meeting. And I thought, man, I'm going to have to only change this thing once a month, and it takes 3 days in order to affect the change. That's going to hamper me, right? Because what happens if the market goes nuts in the beginning of the month or middle of the month? I'm kind of stuck with the position that I have. Well, I've been doing this now for 20 months. And I think that is the best thing that's ever happened. And the reason is it forces me to think longer term. I'm not chasing the next 5 basis points in the market because I can't, because of the way that I've got it structured. So every time we reposition, we're like, how do we want to have this positioned for the next 3 to 6 months? And I'll give you a great example. The best month we ever had was we were positioning long-term. We had a meeting and we initiated our positions October 31st. And it's like, next week is the election. Then we've got the Fed meeting. Then we've got payrolls. And then we've got CPI. And we're going to position a month ahead of that. And we're not going to do anything during the month of November, regardless of what happens. So we had to basically say, forget all that noise. Where do we think the longer term is going to go? And it turned out it was our best month ever. We were at the second percentile of those 470 funds for that month. And we did it all beforehand. And I felt like this is much better because we've had some struggling months too in there. And it's like, and I can like be restful on that. Look, I can't do anything until the end of the month. So the market's moving against me. It is what it is. I don't sit there staring up at night going, should I reposition? Should I change something in some way? I can't. So now it's all about, forget about what's happening in the next 2 weeks. Think longer term. Where do I want to be for the bulk of the year into 2026? And so that has really helped. So like I said, when I went into this, I thought, man, this is going to be so limiting that you can only change it once a month. And I feel like, no, it's just so clarifying. It forces me to think the proper way, because I've been in my research business, I've talked to thousands of managers, and too many of them get so sucked into chasing the next 3% in the stock market or the next 5% in the bond market. They're so lost in the forest, and they forget what they're trying to do because they're just like, how do I position before the payroll report? What should I do before this earnings report comes out? I was like, you are trying to manage money into 2026, and you're getting yourself all bent out of shape about NVIDIA's earnings report or something like that. And so this forces that kind of clarity and long-term thinking on you. And at least for the first 15 months we've been doing it, we've had enormous success with it.
I have no doubt in my mind that enormous success is going to continue, because it sounds like you've institutionalized a process that puts guardrails around many of the common behavioral heuristics that sort of keep most investors from achieving their strategic investment objectives. In fact, I'm actually reading that from a chart. Colin, if you put this on, we featured these 2 slides in every single piece of our research, because what we want to do, in addition to helping our clients make money in asset markets and save money in asset markets heading into drawdowns, is we want to help them become better investors. And sort of there's 3 things that popped into my head as you were explaining that process. 3 of these heuristics that popped into my head. Number 1, the action bias. We all overtrade too much. So forcing that institutionalized process of, your investment committee meeting only being monthly sort of reduces your ability to sort of overtrade your portfolio. There's confirmation bias, or it's four of them actually, really. Availability heuristic and confirmation bias. If the market's moving your way, you're probably going to want to do too much more of that. However, if you have a much slower investment committee process, you allows yourself to incorporate valuations and price targets a little bit better. Availability heuristic. Obviously, we're talking about the Fed meeting, the election, all this other stuff that you can see right in front of your nose that feels like it's a real big market catalyst that a lot of folks position for. But there's obviously what's going to happen in the first half of this year, what's going to happen in 2025 that may have a significant impact. And my favorite, this is my favorite, is the illusion of validity, which is the bias that effectively says we all think we know more than we know. And I think having a process that forces you to, just sort of, I would say, sort of be along for the ride alongside the market gives you more time to learn more things, such that the ratio of I think I know it all in my head versus I actually don't know it all, let me learn more, that ratio gets right sized over time. And so really proud of you for building that. What's the ticker for the ETF?
WTBN Wisdom Tree Bianco Nancy is the sticker. And just to add into what you were saying, you're exactly right on a lot of this, because what I didn't mention, right, was, I got this view about inflation that's been right, or I've got this view about the bond market that's been right, or corporate bonds. I mean, we'll get into that a little bit later about some of these views, but I'm not nailing to the masthead. I've got the secret of what the inflation rate's going to do from now to the end of time, or I've got the secret of what interest rates are going to do from now to the end of time. And so this process allows me to say, here's our belief on where inflation is going to be, or here's our belief on what interest rates are going to do, or corporate bonds are going to do. And then we spend the month constantly challenging ourselves. Mm-hmm. We have it right. What did we miss? And we start thinking about it. And what we found too is that in a lot of those meetings that we have monthly, I wouldn't say a lot of them, maybe a third of them, we go into the meeting, we don't do any change. So it's, so we have the opportunity to change, and then we don't. We say everything is fine the way it is and stuff. And we try and think about it in those terms, because that's why, like I said to you, I have no doubt I'll have a fourth quartile performance, because look at any manager, they all do. And so you always have to, so that to me is, I am not going to, get high on my own supply that I got to figure it out where no one else has it figured out, because they don't. And I'm always starting to worry about, is it still working? And if it isn't working, what is working? And let's move on to that idea.
100%, man. Well, congratulations on that wonderful performance and that process that you've built. I wish you guys a lot of continued success with that. And I think you're going to have a continued success with that, because you are, in my opinion, one of the world's best experts on a lot of the topics we're going to pivot to and cover today. So you talked about your views with respect to, let's pivot to the bond market first, since we're sort of on that topic. I credit you with being one of the earliest adopters, if not, certainly amongst the talking head community, of the higher for longer narrative, and not just importantly early adopters, but really having a credible fundamental framework that argue very cogently and coherently why we were higher for longer, not just that we were higher for longer as a function of the current cyclical dynamics in the economy. I think you understand the change in many of the structural dynamics in the economy better than most. So can we talk? Let's sort of unpack that and then pull on that thread a bit. Where are we in this higher for longer thesis? Is it going to be the linear straight line? Probably not. But generally speaking, what's your take on where we are with respect to the bond market, let's say for 2025?
Yeah, so two things. I'll start with bigger picture. Whenever you have a recession or a financial crisis, this is a shock to the system. Yeah. We had both in 2020 with the shutdown and the recession and the big fall in the markets and the extraordinary action by the Fed. Yeah. Coming out of an episode like that, 2008 before that, 9/11 before that, the economy changes. The financial markets change. And I want to be careful with this word change. Change is not dystopian. I didn't say they get worse. Yep. They change. They're different. And so coming into 2020, we were in a long period of a 40-year bull market in bonds that started in 1981. We were in a period of very low interest rates, very low inflation that was helping to keep bonds keep going lower and lower and lower. The shock of 2020, I've said, I think that ended that cycle. And so I started off with point one. Just like '08 ended a cycle, the financial crisis of '08, we went into the period of quantitative easing right after that when we never had that before. I said I thought that this was going to end that period of low inflation that allowed quantitative easing, and that we were going to see a series of imbalances as we come out of the economy or come out of the lockdowns, and we largely have. The biggest argument I would give you on the change, when I said it's change is not worse, is remote work. About a third of the population right now works remotely. That means remotely is defined as some period of time, 1 to 4 days a week, where you get paid to do your job off of a central location, either an office, a site, a hospital, or something like that. Work from home would be if you did it 5 days a week at home. So remote work has fundamentally changed the labor market. Oh, yeah. It's fundamentally changed the way that we live our lives. There's an imbalance that we saw. We all understand coming out of this, the first imbalance we saw was the supply chain squeeze, which drove inflation up to 9%, and that's come down. But what we're seeing now is we're settling out, I believe, at a higher level of inflation, somewhere around 3 to 4%, not under 2%. Why does that matter? Because that means that the fair value numbers in the bond market mean the Fed might be coming to the realization that the neutral funds rate might be closer to the high 3s or 4%, not 3 or 2%. That means that the neutral rate for the 2-year yield might be around 4.5%. That means the 10-year yield might be in the low 5s. It's about 4.55 right now as we're talking. So these rate levels are not very high relative to what we should expect. They are high relative to what we've seen over the last 15 years, but that was a different cycle. And so along those lines, whenever I see Chairman Powell speak, he always has this phrase that he goes, we see the economy broadly normalizing. We see the economy returning to pre-pandemic levels. And I always kind of yell at the TV when I listen to him. I go, that's the old cycle. This is a new cycle. It's different. We're not going back to that old cycle. And again, don't mistake different for dystopian or worse. It was a banana and now it's an orange. Is an orange better than a banana? No, it depends on your point of view. Is remote work better or worse? It depends on if you're the boss or if you're the employee, I guess, as to how you view it. And so I started with that, and that stickier level of inflation is where it's going to go. The second thing I pointed out was simple bond math early on, which is why I was very bearish on bonds. If I was right about this inflation level and rates were going to go up, the math of getting interest rates off of 0 to 5%, which is essentially where the Bloomberg U.S. aggregate index is, it's about 5% yield, was going to be enormously painful. It was going to be big declines in prices to get the yields up. And as a matter of fact, there's a professor at Santa Clara University named Ed McQuarrie, and he has bond indices going back 200 plus years.
Wow. And
what we've seen over the last 3 or 4 years has been one of the worst periods for the bond market in well over 100 years. It is because we had to go from 0 to 5. The other thing I've been recently counseling about is be careful of momentum thinking. There's so much momentum thinking in these markets, right? What's the stock market going to do this year? It's going to go up 20%. Why? Because it's gone up 20% the last couple of years. What about bonds? Bonds are the most uninvestable asset class that have ever existed. Why? Because the last 3 years have been a disaster. And as far as the bond market, I said, yes, they have been, because we had to get 0, we had to get off of 0, and we had to get to 5. But now that we're at 5, the odds or the probabilities that you're going to see continued disaster in the bond market is going to be very low. To give you one quick math experiment, I said from 0 to 5, according to Ed McQuarrie's data, over the last 3 years, if you held long-term bonds of 10 years or longer, you've lost 19% of your money, worst in 100 years. What would it take now that we're at 5% yields to lose 19% again over the next 3 years? We'd have to go to 16% on yields. Oh, wow. And we're not going to 16%. Or as I once joked to somebody, I said, if we did go up to 16%, your 20% loss in bonds would be your best investment because everything else would be pummeled to death at that point. The point is the bond math says to you, that all of that pain should be behind us. The duration of bonds or the sensitivity to interest rates has come down a lot. So that when interest rates move, the prices don't move as much. And now there's a 5% coupon throwing you off income as opposed to 0.1% like we had 3 years ago. So the structure of the market has changed. And again, so many people are so momentum driven, right? They think, well, the stock market goes up 20% every year because it has. Bitcoin's going to double again because it has. They think gold is going to have another 25% year because it did. And I was like, that's not necessarily a good way to look at it. My favorite meme I've been using on this is from the movie Top Gun, of the original Top Gun, where when he's there and they said, Maverick, that is some of the best flying I've ever seen, right up until the moment you were killed.
Yeah.
Momentum investing is great. You are a hero and you do great with momentum investing until that plane hits the canyon wall and you are done. Then at that point, that's what you got to be careful of when you're a momentum investor. And that's what a lot of people are starting to tell me. No, we're giving another 20% year in the stock market and we're giving 25% year in the gold market. And, and so far for most of January, see, I told you we're on our way to another 20% year. Yeah, but at some point that canyon wall is going to come up on you if you're not careful and you're going to have a real problem.
100%, man. Masterclass, man. So a few things I'll say on the momentum, 100% agree. If you're a momentum investor and don't have signals to tell you to stop doing whatever it is that you previously were doing, you're not investing with momentum properly. I'll just say, Google me if you need more color on that. We don't have time to unpack why I believe that.
The other joke about momentum investors is right on the trends and wrong on the ends is what they are. But the problem is those wrong on the ends parts can be really painful if you're not careful.
100%.
Even though you get that middle part, you think you're a genius in that middle part. That's 100%. What you got to be really careful about.
100%. Our clients know this full well. This is stuff that we've had very, high level institutional conversations with them in our research and in our community chat about how to elongate the right on the trend part and to shorten the wrong on the end part. Right. That's right. We spend a lot of our research in terms of our research and development in designing systems that, shrink the wrong on the ends relative to the right on the trends part. So I think we've done a pretty good job at that. But as always, we're optimizing and updating our models as we do more research to optimize these things. You said a couple of things that I want to unpack. One on the sort of terminal level of the bond, and then two with respect to the structural changes in the economy. Let's start with two because I'm already on the slide. Right. This Colin, if you throw the slide up, this is our secular inflation model. We introduced this back in January of 2022 with the idea, very similar to the idea that you had, in the sense that I don't know if we're going back to the old economy. Certainly, when you look at and analyze as many time series as we do and you do over at Bianco Research and your friends over at Arbor as well, excellent data scientists over there as well. When you analyze as many time series as we do, you can see just visually that we are at different levels relative to the prior regime, relative to the post-crisis, post-GFC crisis era. And so I built a model to quantify the deviation from that prior regime, and it interpolates the sort of either unweighted or weighted deviation across a variety of factors. Some are weighted, some aren't weighted, like fiscal policy, the change in the sovereign fiscal balance of GDP, the change in globalization, using imports as a percent of GDP as a proxy for that, looking at housing supply, household formation divided by existing home inventory, up at 1.9. Productivity has gone up a lot, so that's a disinflationary impulse, as has the advent of technology into the economy. That's also disinflationary. But you also have wage inflation running well above trend, and you also have the amount of cash that's floating around on household sector balance sheets that could be very easily spent into the economy in a moment's notice. That's a 8 sigma relative to where we were prior to the pandemic. And so our math on this, whether you look at it on a raw and weighted basis, says the underlying trend, the equilibrium level of core PC inflation, so the horizontal line in this stylized diagram, is somewhere around 2.9 to 3%. Right. And this model has been signaling that since January of 2022, somewhere between 2.7, I want to say on the low end since then, and 3.2 on the high end, but somewhere around high 2s, low 3s. Is that crazy to say out loud? Because to me, when I look at economic statistics just on a daily Bayesian inference process basis, it seems like we're making progress towards 2, but we're also starting to see a lot of evidence of very relevant time series, including many of these, starting to stall out at levels that would imply we're not getting back to 2. What are your thoughts on that?
Exactly that. I mean, we're seeing the same thing too. Is that there's an anchoring or bias, and there's too much anchoring bias in financial markets. Anchoring bias one is you'll hear Jay Powell say this all the time, like, well, we've gone from 9 to 3. Okay. Yeah. We all knew 9 was a supply chain constraint. Maybe we didn't know it at the day of the 9%, but we soon learned that there was a unique set of circumstances that caused it to go to 9% inflation, and that wasn't going to last. The real question is, are we getting back to 2? Mm-hmm. And if you look at recent data, like for the second half of 24, it's stalling out in the, depending on the measure you use, in the high 2s to the low 3s. This is not 2%. And that is going to be a problem as we go forward, because if you look at financial markets, remember back 2 weeks ago before the CPI number, when the 10-year yield was at 4.80, everybody was like, oh man, rates are too high, rates are too high. And I kept saying, get used to these rates. This is kind of normal. Yeah. And this is being driven by this higher level of inflation. The other thing to keep in mind about inflation, there was a Fed governor, Dan Tarullo. He was there from 2009 to 2017. And I like to joke, the best Fed governors to listen to are the ones that recently leave, 100%. Because then they tell you what they really think. Because basically the job of a Fed governor is you're handed talking points, and you better read them like you mean them. And then once you leave, you can kind of write your own talking points. So he goes to the Brookings Institute. This is October 2017. And he says, the Fed has no working theory on inflation. And he was sincere that they have looked at all the theories. What causes inflation to go up or down? Is it government spending? Is it too much money? Is it technology being disinflationary? And he said, in isolation, you look at all this stuff and it doesn't correlate. And then he goes on to say, because inflation is a funny kind of economic statistic because it's somewhat psychological too. Oh, yeah. Whether or not people believe we are in an inflation period or don't. That's why the Fed is so obsessed with inflation expectations. So I've often argued it is the single hardest thing to understand. And a lot of people on Wall Street would tell me, no, it's the easiest thing to understand. Just look at the money supply number, or look at technological advances, or look at government spending. In the short term, they do matter for inflation. But the bigger picture for the psychology of inflation is really where I think that we've got the big problem, and that people are starting to believe that there's some embedded level of inflation where they didn't before, and it's helped to keep these numbers up. And what you're starting to see, what you mentioned, I'm starting to see the same thing too, is that we're starting to bottom out. Again, why does 3 versus 2 matter if you're not deep into this stuff? Because if you think 5% 10-year yield is going to be a red headline on the quote screens and everybody's going to hyperventilate, I get used to it, because that's kind of the world that we live in right now. We're not necessarily returning to a 2% inflation world. Or to restate it, the reason we would return to 2% inflation is because we're having a recession and we've killed demand. And you might not like the reason that we got back to 2% inflation. But short of that, I think we're in a new higher rate environment. The 40-year bull market in bonds is over. The worst part of the bear market is done, because we had to get from 0 to 5. Now there's a coupon, and now we're going to start in on the second phase.
100%. I couldn't agree more, man. And you made a great point with respect to the pain might be over in the bond market, but that this process really hasn't necessarily concluded. When we do the math on trying to back into what is a fair value for, let's say, the 10-year Treasury yield, we sort of look at it through 2 different approaches. One, the sort of deviation from the long run mean of term premia, and just sort of adding that back, to the bond yield. Colin, if you throw slide 101 up here. This chart just shows 10-year Treasury term premium, which is the excess yield you get as an investor for rolling over short-term paper instead of taking a liquidity risk in the bond market. And when you subtract that deviation from the long-run mean of around 150 basis points, we're talking about 5.5% on a nominal 10-year. So you can argue whether or not term premium should be average or not. I would argue, for a couple of reasons, that you can make the case that it should be above average right now. One, we have higher rates of inflation that are leading to positive excess inflation relative to the Fed's target. So we have structurally less demand, but we also have higher inflation volatility as a function of this higher level of inflation. And those 2 things are, in my opinion, a direct stimulus to the term premium. If you want to take the complete opposite approach, and I'd love to hear your thoughts on this, Jim. If investors and this will be a good place to pivot to the deep sea conversation, because I'm sure you have some great thoughts on that. if you want to take the complete opposite approach as an investor and say, okay, Darius, you're dead wrong. Darius and Jim, you're dead wrong on inflation. Term premium should be low and perhaps falling. We're about to hit into an AI boot-related productivity miracle, and we're going to have booming GDP growth. Then you're talking about a yield curve that is too negatively sloped, or not negatively sloped, but it's barely positively sloped. When in reality, we're over 100 basis points off of a normal level of a 3-month 10-year Treasury yield. And if you want to subtract the deviation from the mean from the current rate, you're talking about a 10-year that's around 5.6% and a 10-year TIPS yield normalizing for, same level of inflation that's somewhere around 3.25. So in my opinion, either way you slice and dice it, the bond market is probably mispriced by 100 basis points right now. There are a variety of reasons from a supply and demand perspective why we could get there in 2025, which, you and I can unpack later. But before we even do that, I'd love to get your thoughts on this kind of analysis.
Absolutely, because I've kind of said something very similar. And what I've often argued again is in 2010 to 2020, we had zero interest rates. They had negative interest rates in Japan and in Europe. And over there on my bookshelf, I've got Richard Sala and Sidney Homer's A History of Interest Rates, 5,000 Years of Interest Rates. The last update of the book was 2005. And I said it's 700 pages. There's not a single mention of a thing called negative interest rates in that book.
Wow.
That period from 2010 to 2020 is unique. Look, they've got interest rates back to Mesopotamia in 3000 BC in that book.
Wow.
And there isn't a single example of negative interest rates. That period was so unique. So when I hear people talk about term premiums at a 9-year high or real interest rates or, at a 14 or 15-year high, and that is an implication that the current level is wrong or too much or too extreme and is exerting undue influence on the markets, I say, no, maybe those are normalizing, and that 2010 to 2020 period was the mistake. It's not that the current level is the mistake. It's you're anchoring yourself back to a period that was unique in 5,000 years of history, negative interest rates, zero money, quantitative easing. That was the unique period. The only reason we could go back to that period again is if you could show that the inflation rate was as dead as it was from 2010 to 2020. The Fed could go to zero and print money and they couldn't get inflation to move. But now you're not seeing any of those signs at all. So I've got a chart with the term premium, and I said, here's term premium from 1960 to 2008, before the financial crisis. It averaged 2.2%. Now, during the financial crisis, it averaged, from 2009 to 2020, the QE period, it averaged negative. Now it's at like 80 basis points, the 10-year term premium by the ACH model. And I said, maybe that 2.2% is where we're headed back to. And by the way, that was the 1970s to 2008. We had bull markets. We had expanding economies. We had relatively rises of living standards with a 2.2%, term premium. But today, everybody thinks that if the term premium went back to 2.2%, that the entire economy would collapse in and on itself. And I don't think it will. And I think that that's the issue that people have to come with. So I agree with exactly what you're saying there.
I appreciate that. That's really, that means a lot coming from you, my friend. I have a view. It's not a particularly high conviction view, but it's certainly a view that is gaining in conviction as I do more research. And one of the things that we've kind of identified that are major risks this year, in my opinion, there's sort of 5-fold hawkish risks that we see potentially materializing sometime in and around mid-year. I'll start with the first risk being the advent of potentially significant tariffs. And I don't care about the economic impact in terms of potential stagflation. What I care about is the impact that it's likely to have in the currency market. Historically, you've seen countries offset tariffs to a significant degree by, depreciating their own currency. So you're talking about a potential, significant move higher in the dollar from here that would drain liquidity and balance sheet capacity to absorb all these bonds, by the way. Number two, you have a potential hawkish shift in Treasury net financing policy. We have incoming Treasury Secretary coming in, Scott Bessent, who you and I both know for a long period of time. Awesome dude. I think he's going to do a great job for our country. But one of the things that I disagree with Scott on is he's been very critical of Janet Yellen's preference for bill financing. And so it's probably likely that we see a shift towards coupon issuance at the margins relative to bill issuance, which would potentially create an even further upward lift in term premium if it hasn't already started already in terms of front running. Number three, we have our model at least has core PCE inflation bottoming in the high twos in the first quarter of 2025 and starting to meander higher from there with, kind of the first, kind of noteworthy acceleration kind of around the latter part of Q2, early part of Q3. If that happens, then you're talking about a Federal Reserve that has to, I would say, accelerate the process that you and I have been arguing for several years. We started talking about this in the summer of 2022 of they have to just positively revise their expectations of what the neutral rate is. It's they've gotten from 2.5 to 3, and I would argue 3 is probably a whole 100 basis points too low. And then finally, number 5, all of those things could potentially be occurring right around the same time as we look into the third quarter of this year. On a lagged growth rate basis, we should have peak global refinancing demand. 2020 was one of the biggest years ever in terms of public sector and private sector debt issuance. So all that paper that was issued at very low interest rates back then has to get refinanced at a much higher term structure of interest rates. Those 5 things, in my opinion, could easily, in my opinion, render you to 5.5 on the 10-year Treasury yield. And if that occurs, I got to imagine we see some pretty significant multiple compression in the stock market as well. What are your thoughts on that?
Yeah, I agree with a lot of what you just said in some of those as you went through those. As far, what was number 1 and 2 again? Just real quick.
Number 1 was tariffs creating a too strong of a dollar from a liquidity perspective.
Right. So that is true. The big issue with tariffs. Now, turn it around as a question to you. What does Trump ultimately want with tariffs? Does he want? Because he kind of says 2 things at once, right? He says, "Look, Mr. Foreigner, you either build your factory in the United States and build your product here and hire Americans here, or I'm going to tariff the hell out of you." Okay, that sounds like a gambit. That sounds like right out of the art of the deal. He's using this as a club to get something else, a deal. Then he turns around and he pivots. He goes, "It's the most beautiful word in the dictionary. Maybe we could get rid of the income tax and just finance the government on tariffs." Well, now that sounds like he's not using it as a crutch or a club. He just wants the revenue from tariffs, and he doesn't care what you try to do to stop me. I just want the revenues. So where do you come down? Do you think it's a gambit that he wants a deal, or do you think he wants the revenue? Because he says both things at the same time.
100%. And I think as just before I answer the question, I think as investors, we have to get more comfortable with the discomfort, the cognitive dissonance associated with some of these competing parties that the sort of new Trump Republican Party are outlining. On one hand, there's supply side economics, Ronald Reagan 2.0. And on the other hand, this is, Jimmy Carter, Barack Obama, let's just expand the deficit in ways that, could potentially be inflationary. Right. The Committee for Responsible Fiscal, so answering the question specifically, I've landed on this just based on our research of fiscal dynamics, that the tariffs will have to be used as part of the reconciliation process as revenue offsets to extend and expand the Trump tax cuts. We can argue over the accuracy of these projections and their projections, so we know they're going to be inaccurate because they're about the future. However, I got to imagine they're somewhere in the general ballpark, given the breadth and depth of knowledge on the Committee for Responsible Federal Budget. You have 2 former budget congressional budget heads on the committee, one Democrat, one Republican. I can't imagine there's too many agencies that know more about this stuff than they do. And they believe that, extending and expanding the Trump tax cuts is about $5 trillion of additional debt relative to current baseline. Well, the issue with using the reconciliation process, and again, we can argue over $5 trillion. If you dynamic score it, maybe it's only $2 trillion. Of course, they're going to dynamic score it. They've been dynamic scoring inaccurately for decades. That's neither here nor there. But even if you say it's somewhere between, let's call it $1.5 to $4.5 trillion of additional deficits accumulated over a 10-year time horizon, you can't do that. The Byrd rule is going to slap you on the wrist and say you need to bring revenue offsets and expenditure reduction offsets to take care of that. And so in our belief, we think that tariffs will be used as a source of revenue offsets to extend and expand the Trump tax cuts in the Senate reconciliation process. We also believe that based on our analysis of all the drivers of the federal budget deficit, it's our belief that Doge is likely to be highly unsuccessful at its mission of achieving significant deficit reduction. Let me be very clear about that statement. I think Doge will achieve significant expenditure reduction. However, they're not going to achieve significant deficit reduction. And there's two reasons. One, we are taking an axe to revenues relative to current law baseline, which has the individual income tax provisions of the Trump Tax Cuts and Jobs Act expiring on December 31st. So just extending and expanding them, obviously expanding would increase the deficit as well, but just extending them relative to current law baseline, you're going to have less revenues than are currently projected by the CBO and other scoring agencies. So that's number one, why Doge is unlikely to achieve significant deficit reduction. They will cut spending, perhaps on the upwards of orders of $500 to $1 trillion per annum. I think that based on our analysis, we think they can get to that level. The issue with that is that does not begin to scratch the surface with respect to the growth rate of the categories that they've already earmarked they're not going to cut. You and I both know Luke Groman, awesome guy, really smart guy, fellow Midwest guy. He and I did a conversation back in December around some of these dynamics, particularly as it relates to Doge. Definitely check that out if you haven't seen that. He's got this true interest expense metric where he adds up Medicare, national defense, net interest, and Social Security. And that is about $4.2 trillion on a calendar year 2024 basis, data through December. 61% of the federal budget, 14% of nominal GDP. It's grown 11%, 17%, and 10% over the last 3 years for a compound annual growth rate of 13%. These are the categories that we know will continue to increase. Medicare is going up because we have more old people as a share of the economy and as a share of the working age population, as is Social Security. We know national defense has gone up. They've already outlined various avenues of where national defense is going up, including rebuilding Star Wars, the missile intercepting system. And then we know net interest is going to be about $100 to $150 billion higher just from rolling over outstanding paper into the higher interest rate regime. So that compound annual growth rate of plus 13%, in our opinion, is probably going to stay north of 10%. 61% of the federal budget will continue to compound year after year at about 10%. So you have to find expenditure reduction offsets just to offset that growth. And on top of the reduction in revenues relative to current law baseline, it may not be an outright reduction in revenues, but it's relative to current law baseline. And so in our opinion, going back to this, this question, I think tariffs are going to have to be a necessary solution as it relates to their, quote unquote, ushering in this golden age of U.S. reform and industrial policy. They're going to have to find ways to do that. And if they do, they're coming, in my opinion. They're coming in size.
Yeah, no, I agree with a lot of that. The other thing I would just add with just kind of kind of an idea about with Doge, this is not new. I'm old enough to remember the J. Peter Grace Commission in the 1980s to reduce the deficit, or Al Gore in the 1990s famously going on the Tonight Show, smashing ashtrays and talking about, some of the stupid regulations that we've had. When Elon says, we want to cut $2 trillion of spending, I always joked, oh, man, you and I could get together in a weekend and we could go through the budget and we could find $2 trillion to cut. Totally. And basically the definition is, it's a $7 trillion revenue line. Yeah. Take it down to 5, but deliver the same services with 5 versus 7. Yes, but now that I've said cut this, and it won't impact anything, try and get it through Congress. I'm also old enough to remember when we had, after the peace dividend came when the Soviet Union fell, that we had to have these base commissions to close the bases, and it was impossible. Do we need this base? No, we don't need this base. So why don't we close it? Because it's a gravy train for the congressman in that district. And he gets together with all his other friends and says, I won't vote to close your things you want. You don't vote to close things that I want. And even though it's obvious what we should do, it seems to be impossible to actually implement that. And that's on the discretionary side. As you correctly pointed out, on the non-discretionary side, if it's going to grow at 10 to 14% a year, I get the argument that, he's going to do, but Elon can't pass the bills. He can only say, cut this and cut that, but he can't make it, he can't turn it into law. And these congressmen have to think about their own political future. And that's where it becomes very sticky.
100%, man. I'm so grateful that you. I tend not to like when the median investor agrees with what I'm thinking, but when folks when folks like Jim Bianco and Jim Carson, who I talked with earlier, agree, that makes me feel a lot better about my line of thought. So appreciate that, Jim. Can
Sure.
we pivot before we wrap
Yeah.
up? I want to get your thoughts on this DeepSeek development because to me, came out of nowhere, huge market catalyst. How big do you think it is?
It is potentially big as a financial event, but not necessarily as an economic event. And even the markets are signaling that. If you look at the way that the markets traded yesterday, I think we set a record yesterday that we had a down 1.5% day, but the advance or decliner line was positive on the S&P for the first time. That was the biggest decline we've ever seen with a positive AD line on the same day. Now, why is that? Because our markets are so concentrated into the Mag 7 being a third of the S&P. What DeepSeek did, and by the way, for everybody who's listening, I'm an expert on DeepSeek, excuse me, because I learned about it on Friday. So I've got a whole 3 days.
The whole 3 days.
Else. Yeah. But basically, I'll put it in very simple terms. Go way back to the inauguration last week. Who was sitting in the front row? All the tech titans.
Oh yeah.
They were all of the gatekeepers for AI. Why were they the gatekeepers for AI? Because it's incredibly expensive. These H100 chips that NVIDIA sells are $40,000 each. You need 15, 20,000 of them to put together, 15 to $20,000 chips, 15 to 20,000 chips that cost 40,000 each.
Wow.
To put together in a data center to do a large language model, it could cost you upwards of $1 billion to do one of these models. On top of that, you have such a huge power requirement that Microsoft has cut a deal to restart part of 3 Mile Island to get this power for their data centers that they're going to put in Pennsylvania. Well, no wonder you've got these 4 or 5 guys up front, and they're saying these are the gatekeepers of AI. And AI, I am of agreement with a lot of people who say it can be as big as the internet, if not bigger.
Yeah.
Now comes DeepSeek. And what it basically said was, first of all, there was the export control in the H100 chips that NVIDIA puts out. That's their top end chip. But they can get H800 chips, their older chip, because there wasn't an export control in that because they weren't considered as sophisticated as the H100s. They came in and they said, instead of 15,000 chips, we did it with 2,000 chips. Mm-hmm. And instead of spending hundreds of millions of dollars on training the model, that means just having the model go through lots of data, cost us $6 million to do it. And then you got guys like Mark Andreessen at A16Z calling it the Sputnik moment, and Sanjay Nadella at Microsoft complimenting them on what a breakthrough that this has been. Mm-hmm. And all of a sudden you go back to the inauguration and you go, okay, this first row of all of these tech guys at the inauguration, they're not just the only gatekeepers for AI. Now there can be hundreds and hundreds of them because they've lowered the cost and they could bring in a lot of other people that can enter this space. So the NVIDIAs of the world, the Microsofts of the world that you thought had this giant moat because they had the money and the processing that they could do these AIs, that moat might not be as big as you thought. So what does it mean for the S&P 493? Not a whole lot. What does it mean for the Russell 2000? Not a whole lot. But for 7 stocks that are 33% of the index, and you thought, you being the general you, thought it had this giant moat that they could have these big fat margins and they could just keep pumping out these H100 chips until the end of time, and everybody has to buy them because it's the only way you could put together these AI models. That whole business model idea concept is now being challenged, and now you're looking at lower margins, lower cost, more entrants, more competition, and that's why you're seeing the revaluation in those companies. From an investor standpoint, what could very well happen if those Mag 7 companies correct is that the indexes could fall behind because a third of the index drags them down, where all these other stock pickers now might rise up, and anything else you own will actually outperform the index, which has been the opposite of what we've seen for the last couple of years. So that's my take on it. It's more of of a financial event than it is an economic event. In fact, if anything, you could argue it's a positive economic event because it's now making the potential of AI more affordable because I won't have to pay these astronomical sums to get a large language model that would be unique to me or unique to my business.
100,000%. I took me about 24 hours to kind of get to a lot of those same conclusions. But one thing I don't know if we departed.
I had you beat by 2 days.
You had me beat by a full 2 days, man. No, I got a client email on Saturday night about this, and I try not to work on the Sabbath, so I deliberately ignored it, even though I could see the screens, the futures, and I was like, I'm gonna have a long day Monday. I'm gonna have a long day Monday. So my general take on this after an additional 24 hours of research, which is, I think Satya Nadella, Microsoft CEO, he brought up this concept of Jevons paradox, which I think we as investors intuitively understand, right? It's the old Warren Buffett adage of, you want to invest where there's an undersupply of capital because the returns are generally high. Well, the opposite of that is if there is an oversupply or if there is deflation, just doing the backwards calculus on this, it probably implies there's an oversupply of the actual good or the actual service or whatever. Mm-hmm. And so you sort of run that back up the flagpole. You're talking about just way more AI, period. Way more enterprise use cases because it's a lot cheaper to run, way more consumer use cases. We're going to have a lot more powerful AI on each one of these bad boys that's coming to you. And so my thought process is, if that's the case, then what I think one of the reasons the market punished the hyperscalers to a large degree on Monday is because they've already committed a lot of capital to developing this stuff. However, if the nominal level of capital doesn't change much, but the per unit, the productivity on each incremental dollar of capital, because they figured out, these much cheaper ways of development, this distillation process, et cetera, you could be talking about the acceleration and adoption of AI dramatically accelerating for the 493 companies. Because, right, if AI doesn't work for the 493 companies, then this whole thing is a disaster. Not just for the Mag 7. If AI doesn't work for me and you, Jim, in our businesses, then they're wasting money to begin with. So obviously it has to eventually have a tremendous amount of enterprise and consumer use cases. And so in my opinion, I think what DeepSeek kind of did in a way, which is, one, on the scary side of things, wake us up to realize that we don't have the stranglehold on tech dominance because we have more money and more resources and export controls. So stop thinking that. But two, if you get as creative as them, on top of having all the resources, then you could actually build some really crazy, powerful things that accelerate real fast, right? Like I played football in high school and I didn't play football in college. Was a fringe NFL player, but that's neither there nor there. We had a saying on our T-shirts in high school my senior year, which is hard work beats talent when talent doesn't work hard. And I always thought, as being one of the better players, but when talent works hard, I'm going to kick your butt.
Right.
You know what I mean? And so I'm thinking of in that sense that this actually might be a wake-up call for them to sort of repivot and reimagine what's possible. And it could really accelerate the adoption curve of AI. So who knows? That's just maybe wishful thinking, but we'll see.
Yeah. And to give you one example, I was at an investment conference this past weekend. And one of the speakers there was a real estate guy who is in the business of building data centers. And his biggest fear, and he was talking about, this is really when I first became aware of it, he was talking about DeepSeek. And he said, this is potentially my worst nightmare. And he had these pictures of these gigantic data centers that they were building, and the power requirements are insane for these things. And he says, what if the technological breakthroughs are that this whole thing can be reduced to a shoebox that can be run off a 110 outlet? Now, we're not there now, but they did find a way to dramatically decrease the size and the power needed through DeepSeek. And so all of these expenditures are based on this idea that we need these gigantic data centers. What is it? Meta is building a data center that is 3/4 the size of the island of Manhattan. Wow. At some point. Do we need that? Do we need that? And so, yes, they've got $80 billion that they're going to spend a year, and you're going to build that. But the technology might say, no, it only needs to be 100,000 square feet. It doesn't need to be miles and miles and miles. And it doesn't need a nuclear power plant next to it to power the thing. And so this is what we're going to have to face with these Mag 7 stocks. And again, that isn't an issue if you're trading at a 20 forward PE or if you're trading at an 18 forward PE. But when you're trading at 30, 40, 50 forward PEs and you're expecting massive growth rates with these companies, then it becomes an issue. It's also not an issue if it was like the old, .com boom where you had the JDS Uniphases and, the pets.coms, and they were 0.75% of the index here, 0.5% of the index here. No, these are now 6% of the index, 7% of the index, 5% of the index. So if they have problems, or if is the thing you hear online is that NVIDIA just hit its Cisco moment. Remember, in 2000, Cisco was the one that was building all the routers for the internet. Yeah. And then the internet moved to fiber, and all of a sudden, we didn't need as many Cisco routers, and it imploded on itself because the business model changed so fast. Yep. That is a problem because of the scale of the size, the concentration in the stock market. And that's why it impacts all of us, which is why I've liked to joke that if you ask me the three most important people, I used to say this before this weekend, if you ask me the three most important people for investors in 2025, in third place, I put Jay Powell. In second place, I put President Trump. And in first place, I put Jensen Huang, the CEO of NVIDIA. They are going to determine everybody's returns in that order. And right now, it seems like that's the way it's playing out.
Yeah, 100%, man. That was a masterclass, Jim. Thank you. Oh, by the way, NVIDIA reports earnings on February 26th. So that's going to be bigger than the Fed day. Way bigger.
Exactly. Yeah. We'll all be holding our breath all day. I know we've already seen it, that there's been a couple of NVIDIA earnings reports. The last hour of trading kind of just grinds to a halt. Yeah. Everybody goes to the bathroom and gets their new cup of coffee, and okay, I'm getting ready for this thing, man. It's that big a deal, totally. And stuff like that. And no other company I've ever seen has dominated. Their earnings report is dominated like theirs has, and it's going to be even bigger the next one.
The only time I've ever seen in my career was Petrobras and Vale in Brazil.
But at least he's got a month. He's got a month to figure this out, right? Because you've got like Meta and some of the other ones that are reporting like in the next 2 days. So Zuck's got like, okay, Zuck, here's this cruise missile that's been launched at your business model. You got 3 days now to come out and tell me what it means. At least Jensen can hide for a month and kind of you let the dust settle a little bit more before he tells us what it means for NVIDIA.
100%. Well, fees, hopefully they watch this, and I'll let you go, Jay, because you've been very generous with your time. Jensen, if somehow this gets into you, I got friends who are very important tech PMs that own a lot of your stocks, so maybe they can send this to you. If I were you, I would spend that entire conference call telling people how if Meta and Amazon and Apple do what DeepSeek did with any one of these Blackwell chips, they'll be able to do DeepSeek times a trillion. That's what you need to reconvince the market is, okay, yeah, they did this little thing over there. It's awesome. It's performing really well. But if you actually did that with these, now we're talking, we're going to go from high school football to what's about to happen in a couple Sundays.
Right. Yeah. Exactly.
That's what they need to tell people. And
you've got to be able to do it in a way that, the power needs are much less. The infrastructure is much less.
Totally.
And the like. But I think like I said, just emphasize, I think the market's realization was this whole idea with the hyperscalers and the data centers is we need these gigantically large places with nuclear power to feed them and stuff like that. Maybe we need to rethink that model. And for now, they were caught off sides. They're plowing ahead with Stargate and all this other stuff in a business model that may not be the way that it's going to go. We just learned that in the last week. Now, can they pivot? Sure, they could pivot. But what we're going to find out is they're going to pivot right into 100 other people competing with them, 100%. Not 3 or 4 other people competing with them.
100%. Amen to that. Well, Jim, man, this is awesome. Super fun, man. I knew I would have fun doing this. You're an awesome dude, awesome educator. Where can I send the people who've been literally sleep under a rock for the past decade plus 20, 30 years to find you, my friend?
So 2 places. I'll start with my research business. BiancoResearch.com is our research business. It's an institutional product, which means it's kind of expensive. But if you are somebody that subscribes to that kind of stuff, you can subscribe. You can ask for a free trial or ask for more information at BiancoResearch.com. If you're a retail investor, I try to stay active on the socials at Bianco Research on YouTube, at Bianco Research on X, and under my name, Jim Bianco, on LinkedIn. On the ETF side, BiancoAdvisors.com tells you all about our index, and WTBN is the ETF that tracks us. For those of you that might not be familiar with it, think of it like the index committee at the S&P 500. The index committee at S&P manages the S&P 500, and SPY just tracks it. That's kind of the way that our ETF is set up with our index.
Amazing. Well, hopefully some folks come check it out. Guys, go check out Jim if you haven't. If you're one of those people who've been sleeping under that rock, definitely check out Jim. I've learned a lot from you, Jim, over the years, and just want to say all the best to you. God bless you, and we'll do this again in the future.